Welcome to the Deep Dive, where we really try to cut through the financial jargon and pull out the key insights from the latest earnings calls, getting them straight to you.
Yeah, making sense of it all.
Exactly. Today, we're digging into the second quarter 2025 earnings call for Las Vegas Sands. That's ticker LVS, of course.
Right.
Our goal, as always, is to break down the complex stuff so it makes sense fast, get you those aha moments without wading through hours of calls.
And this LVS call, well, it definitely got the market talking.
Oh, absolutely. It showed, truly outstanding performance from one key spot and a really clear strategic shift in another major market. It paints a pretty compelling picture for where LVS is heading.
It really does, because you've got these two sort of distinct stories playing out at the same time, but they fit together really well.
That's so.
Well, on one side, you have Singapore just knocking it out of the park, like unprecedented numbers. Right. And then on the other side, you've got Macau, where they're admitting some issues, but making this really aggressive, proactive turnaround effort.
Okay, so let's start with those numbers then. The big picture. Strong results overall, right? Mostly thanks to Singapore.
Undeniably strong, yeah. Singapore was the engine this quarter.
Okay, unprecedented for Singapore. Let's hit those headlines because, wow. Marina Bay Sands pulled in a historic $768 million in EBITDA.
Historic is right. Just a massive number.
And the mass gaming and slot revenue, $843 million. The growth there is just staggering.
Nearly double 2019 levels, you said.
Almost double pre-pandemic levels, yeah. And up 40% just from last year. It's a huge acceleration.
But the thing that really jumped out at me was the margin. 55.3%. That's incredible.
It is. That margin isn't just good, it signals real dominance.
What does a margin like that tell us? Beyond just good profit.
Well, look, a 55.3% margin is like almost double what you might see in other more competitive markets. It points to a few things working together perfectly.
Like what?
Like attracting really high value players, super efficient operations after all the money they've put back into the place.
A reinvestment, yeah, exactly. And, the fact that it's basically a duopoly in Singapore, limited competition helps immensely.
So even if the hold was a bit high this quarter.
Right. Even if you adjust for that luck factor, the underlying business, the way it's positioned, it's just incredibly strong. It suggests Marina Bay Sands is making money at a level that's frankly hard to replicate anywhere else. Okay,
that makes sense. A huge differentiator. So, while Singapore is setting records, Macau's EBITDA was $566 million. And management, they were pretty upfront, right? Said it underperformed.
They were, yeah, candid about it.
But they didn't just leave it there. They talked about this quick strategic pivot they started mid-quarter. What was that all about?
It was refreshing, actually, how open they were.
Yeah.
The pivot is basically about customer reinvestment.
Yeah.
Getting much more aggressive.
Meaning, like, comps and marketing.
Yeah, essentially admitting they maybe got a bit complacent, relying on their fancy buildings.
Oh, yeah, the hardware.
Exactly, instead of really focusing on incentivizing and rewarding the players. So late April, they switched gears, started this more aggressive reinvestment program. The goal, win back market share and crucially boost that EBITDA number. It's a real shift in how they're approaching Macau.
And it sounds like they're actually doing it, not just talking. Now, beyond the operations, they also showed a real commitment to shareholders, didn't they?
They did. Big time. They bought back $800 million of their own stock just in this quarter.
$800 million, plus the dividend?
Yep. Paid the regular $1.95 per share dividend. And on top of that, they bought back more shares in Sands China, bumping their ownership up to 73.4%.
Wow. Okay, so the question is, with Singapore throwing off so much cash, can they keep up that level of buybacks and dividends? Is it sustainable?
That's the key question, right? And look, given how strong Marina Bay Sands is, it certainly looks sustainable, especially now that the big spending on the Londoner project in Macau is winding down.
Right, less CapEx needed there.
Exactly. So management sees these buybacks as, quote, meaningfully accretive. Basically, they think their stock is cheap and buying it back is a great way to return value, maybe better than some other options right now.
A strong signal, definitely. Okay, let's dive a bit deeper then. Back to Singapore, the powerhouse. We mentioned the huge EBITDA and revenue numbers, but management even hinted they might hit their big target, $2.5 billion annual EBITDA this year.
Yeah, they floated that possibility, which is just, an incredible amount of profit from one single resort.
How did they get there so fast? Was it just luck?
No, they were pretty clear it wasn't a fluke. They actually sounded a bit almost confused themselves by the speed of it, but they put it down to years of putting money back into the property.
Improving the rooms, the service.
All of it. Better guest experience. Plus, you've got the bigger picture. Growing wealth in Southeast Asia, more high-end tourism, new customers coming in. They called it a very deep market.
A deep market, meaning there are plenty more high-value customers out there.
That's the implication, which is really encouraging for the long term. It suggests this isn't just a flash in the pan.
Okay. So despite these record numbers, they did say, don't get too carried away. But they also said $600 to $650 million plus EBITDA per quarter seems totally possible going forward.
Right. Which suggests a new higher floor for performance.
Yeah.
They kept talking about their privileged position dominating this super high-end market there.
So they think their competitive advantage, their moat, is really strong and will last.
Seems like it. They believe they've locked into a clientele few others can reach. So yeah, maybe $768 million was a peak, but the underlying strength should keep profits consistently way above where they were before. It's a reliable cash machine.
And they're still investing there too, right? The new IR2 project.
Absolutely. They just broke ground on the new $6 billion expansion integrated resort 2. And importantly, they're building it right next door, trying hard to minimize disruption to the current hotel and casino.
Which shows long-term belief in Singapore, definitely. Building for the future while keeping the current engine running smoothly. That's quite the balancing act.
Yeah, it shows they see Singapore as a unique, long-term, high-value play.
Okay, so from those sunny skies in Singapore, let's pivot back to Macau. Different story, but like you said, maybe just as interesting.
Right, where management basically said, okay, we messed up a bit here.
Yeah, we underperformed, we weren't aggressive enough on reinvestment, we leaned too much on the buildings, that kind of honesty.
Which you don't always hear that on earnings calls. So they start this more aggressive reinvestment program in late April. Are we seeing results yet? Is it working?
Early signs are positive, yeah. They pointed to an 8% sequential jump in their mass market GGR share. That's the non-VIP gaming revenue, mostly coming in May and June. So a pretty quick impact.
Okay, 8% sequential gain. That's noticeable. And what about the Londoner? That's their big new asset there. Right. The Londoner Grand, all 2,450 rooms fully open since late April, apparently getting fantastic customer reviews, and is tracking towards that goal of $1 billion in annual EBITDA.
$1 billion just from the Londoner, wow.
That's the target. And management said it still has, quote, much further to go in its ramp up. So they see even more upside there.
Okay, so if Londoner is ramping and the reinvestment strategy is kicking in, what's the overall target for Macau now?
The short-term goal they laid out is getting the whole Macau portfolio to a $2.7 billion annual EBITDA run rate.
Up from
the current, say, $2.2 to $2.3 billion range. So a pretty significant jump they're aiming for.
And Londoner and Venetian are the main drivers for that.
Yeah, they expect those two combined to eventually contribute $2 billion of that $2.7 billion target. They're the big engines for the Macau recovery. It gives you a clear path to watch.
Now, the overall Macau market GGR picked up in May and June. They mentioned events helping, a strong VIP segment, but also a decent growth in mass market, too.
Yeah, high single-digit growth in non-rolling and slots. So it wasn't just VIP. Management was a bit nuanced about events, though. They kind of suggested events mostly shift when people visit, rather than creating totally new demand.
Interesting distinction.
But crucially, they sounded really encouraged by the market's overall direction. They even used the phrase pre-pandemic Macau to describe some of the recent activity levels.
That's a strong comparison. What about margins in Macau? Did the extra reinvestment hurt margins?
Margins did dip slightly, yeah. Adjusted EBITDA margin down about 80 basis points. But management basically said, look, with our huge fixed costs, driving total revenue and total EBITDA dollars is the main goal right now.
So maybe accept a slightly lower margin percentage for more overall profit?
Exactly. Optimize for growth. They plan to use that targeted reinvestment across other properties too, Parisian, Sands, Four Seasons, not just the big ones. It's about lifting the whole portfolio.
And what about non-gaming? Retail? Any signs of life there?
Yeah, actually. The malls showed a decent recovery. Tenant sales up 10% year over year. And even luxury goods, which have been soft, started to show improvement, helped by some new big brand stores opening up.
Okay, so broader spending seems to be coming back a bit. That's positive. Any word on visitors? Where are they coming from?
Still seeing a slower recovery in visitors from mainland China outside the immediate Guangdong province. But the company is actively marketing to attract those higher spending overnight visitors from further afield. using the better transport links, the new hotel rooms, trying to get quality over just quantity.
Makes sense. Okay, shifting gears slightly. Capital allocation, future growth. They're committed to shareholder returns, right?
Yeah.
Dividends, buybacks.
Absolutely. Reaffirmed it strongly. And with the Londoner spending winding down, they hinted they expect to increase the dividend over time. And like we said, they see buybacks as really adding value right now. Very disciplined.
And any hints about totally new markets, expanding beyond Singapore and Macau?
They confirm they're always looking. Specifically mentioned Thailand as a potentially significant opportunity in Asia. But they also flagged, legislative uncertainty there. So keeping an eye on it, being opportunistic, but waiting for things to become clearer.
Okay. So let's try and pull this all together for you, the listener. What's the big picture investor takeaway here?
Well, first, Singapore. Marina Bay Sands is just a monster. Its performance, the reinvestment paying off, the strong government support. It really cements its position as a leader in high-value tourism. It looks like a source of incredibly strong, maybe even growing cash flow and margins for the foreseeable future. Engine number one is firing perfectly.
Right. Engine one, solid as a rock, maybe even accelerating. Then engine two, Macau.
Yeah, Macau's the turnaround story. Management's honesty about the problems, the quick, aggressive changes they're making, especially on customer reinvestment, and the Londoner hitting its stride. It shows a really proactive team working hard to win back share and boost profits.
And you've got clear targets to watch there, right? That sequential GGR improvement, the push towards $2.7 billion EBITDA, things investors can actually track.
Exactly. It's not just hoping the market lifts them. They're actively trying to grab share.
So it really highlights this balanced strength in the LVS portfolio. You've got the super reliable high margin cash cow in Singapore, and then this big growth opportunity in Macau that they're actively managing. Stability and comeback potential together.
Well put. And underpinning it all is that capital return story.
Yeah.
The consistent buybacks, the plan to raise dividends as CapEx falls. It shows a real focus on shareholder value, driven by confidence in their assets and their strategy.
Okay, fantastic summary. Now let's move to our favorite segment. This is not financial advice, where we toss around an outrageous but plausible trade idea.
Let's do it.
So given everything we've just discussed, the frankly stunning numbers out of Singapore, which even management seems surprised by, plus this very active, seemingly effective turnaround plan in Macau, with the Londoner just getting going and a real focus on reinvestment.
Yeah. Where are you going with this?
Here's the audacious idea. Go long Las Vegas Sands, LBS, but maybe juice it with an aggressive option strategy. Specifically, thinking a long call spread, targeting upside way beyond what analysts are currently forecasting, maybe over the next 12 to 18 months.
Okay, bold. Explain the thinking there. Why options? Why a spread?
Well, the core idea is that Singapore isn't just good. It might be entering, as they said, a whole new world of profitability, a really high, sustainable base of EBITDA that provides a strong foundation.
Right, the cash engine.
Exactly. And the buybacks help too, constantly adding value underneath. Now, the options play, specifically a long call spread. Well, you buy a call at one price, sell a higher strike call. It limits your upfront costs compared to just buying calls outright, and it defines your max profit. It's a way to make a targeted bet on the stock moving up significantly, but within a certain range.
So you're betting on more upside than the market expects, but capping your potential gain and lowering your entry cost.
Precisely. And the reason for that bet, it's not just Singapore, it's coupling that strength with the Macau turnaround. Management's shift there seems decisive. GGR is picking up, Londoners ramping. You're betting that both engines start firing much stronger than consensus believes.
So the outrageous part is betting heavily on this dual acceleration, especially given Macau's historical ups and downs.
Yeah, that's the leap of faith. But the plausible part comes from management's demonstrated ability to pivot fast, the sheer quality of the Singapore asset providing that base, and the clear signs of execution in Macau already. It's a bet on both stellar performance and a successful turnaround happening concurrently.
A bold play on a dual-engine recovery indeed. Okay, so recapping our deep dive today, we really dug into Las Vegas Sands Q2 2025 call, covered the incredible success at Marina Bay Sands.
The strategic reset happening in Macau.
And a management team that seems adaptable, leveraging great assets, and very focused on returning cash to shareholders.
Absolutely. Now remember, everyone, what we share here is purely for informational purposes. It is absolutely not financial advice.
Please, do your own research. Talk to a qualified financial professional before making any investment decisions. Always.
Definitely. And maybe a final thought to leave you with.
Yeah.
As we think about these giant integrated resorts, what is the real ceiling for a market like Singapore, where even the company seems amazed by its own success? And relatedly, how quickly can a big player like LVS really turn things around and reclaim dominance in a super competitive place like Macau?
Good questions. Food for thought.
Think on that. Thanks for tuning in, and we'll catch you on the next Deep Dive.